talking about dividends. OUR is our Europe strategy. Kind of popping this sort of surprise on you. If you don't have a view on Europe, that's completely fine. OUR is large cap. It's 50 stocks. It's designed similar to OUSA to use the same scoring method of profitability, cash flow to debt, dividend coverage, dividend growth, and does not own any oil stocks. We're not a big fan of the oil stocks generally, and certainly if you own them, we may as well own the US ones rather than go off to Europe and own the European ones. We're not a big fan of European banks. Some of them are okay, but some of them are really not okay. And so you find very little exposure to those in OUR as well. It's a very selective approach using those metrics. It's not generic Europe and has yield and yield growth. That's my quick pitch for what OUR is, because I'm guessing you maybe didn't have a chance to look at it, which is totally fine. What do you think of Europe generally? I mean, the zip code, their COVID Delta exposure seems to be better than the US at the moment. They got some global leaders in their companies, ASML, for example, on the chip manufacturing side. Nestle, that is many people probably think it's a US company, and Roche and Novartis, a bunch of healthcare companies that are in Switzerland that actually people probably think are US companies. What are your thoughts on Europe generally, with their policies, their economy?
I tend to be with you on the European bank front. I try to talk myself into the idea that there's a lot of potential there, but I mean, it's like you said, it's the home run swing. You can either put it in the seats or you can strike out. And I think there's, you've got a real challenging interest rate environment over there, and they're having trouble sort of generating organic loan growth. And you got, the Deutsche Banks of the world, which have very risky balance sheets that could, implode at any moment. So I tend to agree that the banking sector is a little challenged, but I tend to take a view of sort of Europe at a high level compared to U.S. stocks. And I think if you look at a long-term chart of international developed market stocks against the U.S., you've seen that they kind of outperform and underperform in like 10-year cycles. And this last 10-year cycle obviously was terrific for the S&P 500, and international stocks, depending on the time frame you look at, have been like dead money over the last 10, 11 years. So just from the prospect of long-term growth and valuation, I think you have to really like international stocks here. I've been ringing the bell on emerging markets for about the last 3 years, and I swear it's going to pay off any day now, even though it continues to disappoint. But I think you just have to remain diversified, and you have to consider Europe here. I think we're probably going to get into a period where Europe starts outperforming again. I mean, will it happen in the next year or so? It could happen in the next 2 years. I'm not sure. But I think if you're somebody who's interested in holding on to something for the next 10 years or so, I think international emerging markets are a good opportunity. They're based on valuations alone and growth rates. I think, like you've said, I think you probably want to stick on the more defensive end of the spectrum. And by defensive, I mean companies with strong balance sheets and strong cash flows, and looking at the companies that have paid and grown their dividends over time, because those are the ones that are going to sort of lead that continent out of the COVID recession and kind of some of the geopolitical risks and things like that. So I'm bullish on Europe. I think it's going to do well. It's going to have periods of volatility. It's going to have periods of underperformance. I think you need to expect that. But if you're looking out into the long term, I like the growth potential. I like the valuation. So I'm on board with Europe and as a long-term investment.